Hello, everyone. I want to welcome you to our very first Edelman Smithfield virtual roundtable. A good morning and a good evening to you. My name is Jason Liao. I'm the head of APAC for Edelman Smithfield and your host for today's event. Today is a festive holiday in some parts of Asia. So let me wish those of us celebrating Selamat Hari Raya Haji and Eid al-Adha. Thank you for making the time. Now, before I set the scene for today's discussion on impact investing, emerging trends in Asia, let me allow me 30 seconds on an elevator pitch about Edelman Smithfield. As you may know, we are the financial communications boutique inside Edelman. We support financial services and all forms of transactions, including M&As, IPOs, and restructuring. We also have teams focused on ESG and activist defense work. Globally, our clients manage around $20 trillion. Our APAC team, which is running today's program, a special shout out to Tana Zhang and Daniel Lee in the APAC team who's put together this program. We are part of a global collective of some 250 advisors spread across the Americas, EMEA, and of course, APAC. In APAC, we have consultants across a dozen cities. So now with that, let's get to why we're here today to discuss impact investing. First, I'd like to set the scene using our annual Edelman Trust Barometer survey. In this case, it's a cut that looks at trust in the financial services sector. Yeah. And these are findings that's culled from 28 countries with over 30,000 respondents, so the observations will be quite robust. Now, what do we know? Top of people's minds, economic anxieties. You can see from this slide a dramatic collapse in economic optimism this year in several APAC markets. It's a 17-point drop in Hong Kong and a 7-point drop in Singapore. I've called out these two markets because these are important financial centers in our part of the world. Now, even in Indonesia, where we often say, you know, is a high potential market, we've seen an 8-point drop in economic optimism. Now, people across multiple markets are looking to leaders for help, and by leaders, people aren't thinking of government globally. Governments are now less trusted than business, except in Singapore and China. Now, when we say least trusted, here we're referring to the financial services sector, right? And as you can see, financial services sector among a spectrum of sectors that we've polled come in at the second to last, yeah, just before social media, yeah. Now, this being said, it's important to note that 59 points for the financial services sector is really the highest that the financial services industry has chalked up in recent years. It's 1 point up from the last cycle. So at 60 for the purposes of our survey, 60 is when an institution is in the trusted range. So financial services is at the cusp, yeah. So when they do, so there's potential for our sector to be building more trust, to be more purposeful, to be seen as taking meaningful action for our communities. There you go. If you look across our region, financial services in India, Indonesia, China, Thailand, Malaysia, Singapore are trusted. Yet this part of the world, compared to financial services globally, appears to be doing better. It appears to be perceived as more trustworthy. And this means that it provides financial players here with a lot of room to demonstrate positive action. The exceptions, as you will see from this slide, are South Korea, Australia, and Japan. I would like to point out that Japan in particular, it's not unusual. South Korea and Japan in recent years have come in very low on trust scores. It will be interesting to see if this will be the case for Japan when we go back and poll for next year and the following year, given that there seems to be now more optimism. There's been a return of optimism to Japan in the last 6 months, and investor activities have once again returned and are ticking up. So perhaps we're not, that's my personal speculation. Perhaps we're going to see trust scores and optimism increase in Japan in the next 2 years, but let's see. That is an interesting market to watch, yeah. Now, what's behind that trust? We say that in the previous slide, we say that APAC appears to be a more trusted zone than globally for financial services sector. So another way to put it, how do we continue to build that trust? Now, financial services players need to show, and there are 4 things they need to do. They need to show that they're good at what they do. They need to demonstrate that they're making a positive impact on society. Now, they should also show that they can keep the promises that they have put out in public, and they're seen as honest and trustworthy. As you can see, financial services companies in Singapore are solidly above global benchmarks and are in a good place to build their trust dividends. I call out Singapore given that a lot of our Edelman Smithfield APAC colleagues are based here, and it's an important market for us in this part of the world. So what are some takeaways from the trust findings, which will set the scene for our panel discussion taking place in a while? First and foremost, businesses are expected to deliver impacts where governments have been seen to have failed. Secondly, financial services sector is at a turning point. So just now I said the trust scores for financial services is at 59, just 1 point away from being trusted. So it's at a tipping point, and this sector has the potential to be trusted by the public if it takes positive actions and show impact on society. Therefore, the third and last takeaway is that trust is built on making a positive impact, keeping promises, and being seen as honest. In other words, doing good work and doing what you say you would do. Yeah, with these findings, I'm now going to turn the time to Sushan, my friend and former colleague who will moderate today's discussion with our panelists. So over to you, Sushan.
Thank you, Jason. Good morning, everyone, and welcome to the Edelman Smithfield Roundtable on Impact Investing. For those of us who have been following sustainability and ESG investing, the last few years have been incredibly busy. One of the ESG investing approaches that has taken hold in the public consciousness is impact investing, and that's something we've probably seen from the findings that Jason talked about earlier. And because with impact investing, it's really a win-win situation. You have investors who can benefit from positive financial returns, but the society benefits as well. And actually, research suggests that this impact investing is going to grow about 30% globally from 2020 to 2025. And, other types of ESG investing will grow, but, slower, 15 to 25%. So today we want to discuss emerging trends, challenges in impact investing in APAC. Companies are definitely aware of impact investing, but, how much is this for show? How much has awareness permeated throughout the organization? And how can companies demonstrate that commitment to impact investing? So we've got a lot to get through today, but Edelman has managed to get our 4 amazing panelists here today. They've got a diverse experience in the area of impact investing. So I'm sure we're going to have a robust discussion. So let me do a quick introduction. We've got Dominic Miller. He's got extensive banking experience, and he's in charge of early stage impact investment initiatives with the ADB. As the co-founder of ADB Ventures, he oversaw the investment in 40 climate technology companies, and Dominic is based in the Philippines. We've got Ramnath Iyer from the Institute for Energy, Economics and Financial Analysis. He's advised clients on ESG implementation, sustainability, but he now focuses quite a fair bit on climate and renewables. He sits on a board of the NYSE-listed Global Renewables Development Company, and Ramnath is based in Singapore. We've got Aisha Khanna from Care Enterprises. Care is launching its next generation of impact investment funds to finance small and growing businesses and advance the cause of gender equity for women. Aisha is based in the US. And we've got Sharon Shen. She's the MD at TPG, where she heads its China operations. And she has overseen TPG's impact and consumer and FIG commitments in the country. And Sharon is based in Hong Kong. So we've got everybody from all over the world. So perhaps let's start with Dominic. Dominic, perhaps you could help us set the stage here. How do you see impact investing along the continuum of sustainability practices? What are some of the emerging trends of impact investing you see in APAC?
Yeah, thank you, and good morning, everybody. Actually, I'm calling from Cambodia, Phnom Penh, not Philippines, but it's still in Asia. So, to answer that question, maybe first just to give you a bit of, give the audience a bit of perspective on the particular lens I have, because ADB is a very big organization in itself. So I'm part of the private sector operations department that is investing in companies, and my specific role is to try and mobilize co-financing to invest in Asia, as well as we also set up our own funds asset management business inside ADB. So I get a lot of different perspectives across the region on impact investing from financial institutions, corporates, of course, governments, other development financial institutions, and the businesses in the region that are looking to raise the funds. And I think generally in Asia at the moment, so Asia in itself, there's a lot of misconception within the region about what is ESG and what is impact investment, particularly within the region. And of course, ESG is do no harm, and impact investing tries to go further than that to actually do good from the investments we see. And so when we talk a lot to particularly within Asia, financial institutions, corporates, they're still trying to sort of figure out that difference a bit and figure out and also understand concerns around greenwashing and how do you really measure and monitor impact. But there is definitely a concerted effort to try and to mobilize more assets within that space. Generally speaking, across the region, a lot of the flows that come into the region for impact investing are still coming from outside. So it's mainly from North America, mobilizing funding from Europe, more developed markets. But one of the trends we're seeing is that there is definitely more and more interest from within the region to invest in the region. So we're seeing more and more impact investment interest from like Korea, from Japan, and I'm sure also from China, as we'll probably hear later as well. So I think that's a promising sign because there's so much savings in the region. And what's driving that trend? I don't think it's purely philanthropic, but it's just there's a huge market opportunity. So if you look at like some of the development problems that need to be addressed in the region, you asked about the trends. So definitely I would say that climate and environment are huge trends, movements in the region. And Asia as a destination, as a location, is still contributing to the majority of CO2 emissions globally. So if you're trying to tackle the problem globally, you have to start and tackle the problem in Asia. And a lot of the solutions and the business models to address these solutions are now being enabled by lowering cost of technology as well. So maybe 5-10 years ago, some of these business models were not maybe viable, but now we're seeing some of these business models becoming viable. So it's not purely just for impact, but there's big business opportunities here because the market is huge, population is huge. And on top of that, we're also seeing that, you know, with the Paris Declaration, government commitments at policy level within the region, we're seeing maybe a more attractive enabling environment for some of these investments in these areas like renewable and climate technology. And so the corporates themselves have also made a lot of commitments around reducing their footprint. Now that they're not just purely CSR commitments, but they're also very much commercial, because to get continued access to European markets, you need to be able to show that your operational footprint is clean in Asia. So to do that, they have to invest in their own supply chains and invest in their own solutions to solve that problem. And so we're seeing definitely a big trend towards more and more interest from corporates and large FIs. And I would say in terms of where the gaps are, ADB operates across the entire continuum life cycle of projects and businesses, from very early stage to more brownfield, late stage. I think generally the trend, particularly during COVID, has been towards later stage and larger investments. But we think there's still a bit of a gap in the early stage space around investing in innovations that can just solve some of these problems in Asia. But it's great also to see that there's more and more interest from impact investors, even family offices. I came back from a conference in Korea recently called Asia Impact Nights, where they convened a lot of the family offices and impact investment houses around the region. And everyone's very much interested in tackling these problems and finding solutions. So I think overall it's a very positive. It's still very niche, particularly within Asia, but it's growing, and people want to invest for market returns as well as impact as well. So maybe I'll stop there, because I'm sure there'll be more opportunities to talk about it later. Thank you.
Yeah, thanks, Dominic. So I think you've got a few points there: business opportunities, movement into Asia, and so on. So perhaps I could tap on Sharon. You could talk a bit about China and so on. What are some of the trends that you see there?
Sure. Thanks, Shan. So I think Dominic has made some great point and observation that there's definitely kind of more awareness. I recall the past, maybe a bit kind of perspective is that TPG is one of the largest and the earliest kind of impact investment. The Rice Fund is one of the earliest and the largest impact investment fund from the kind of formal financial institution perspective. And if I recall the past, since 2017 till now, that I would call that the first phase is probably between 17s to 2020s, where we actually have to do a lot of advocating and efforts in order to kind of bring the awareness of impact investment and what is this all about. Versus the second stage, maybe starting from 2022 now, is that it's more of clarification work and crystallizing that exactly what impact investment is to our kind of perspective and definition, because there are just like so many institutions that are emerging out of the space, even just within the China kind of set context. So that's one backdrop, is that there's definitely a lot more awareness, interest, and incoming kind of institutions from different pockets of capital that's kind of coming into the space, which is a great thing. And I think the second part is also extremely important. As Dominic has mentioned, that there's quite some effort trying to bring the capital and attention to the early stage companies. From our perspective is that looking at the China kind of context, the biggest impact driver is actually the Chinese government. If we're kind of quoting that a few of the themes that, for example, the poverty elevation, the common prosperity, and also the focus on the quality of the development. So those are the large things that's working at the backbones of the society, that those are huge kind of powerful force that's funded and supported by government and also large SOEs. What is exactly the precision of the private financial institutions and also the social forces that's kind of like that can actually bring value and help to drive change? Those are the I guess, kind of key themes and the focus, and also the areas for us to put in a lot of thoughts that how do you kind of fit in the big theme, but still kind of find the opportunities for the private kind of sectors. The ecosystem is definitely kind of building up, and I couldn't kind of emphasize the importance and the value of the ecosystem. When we first started kind of working in this space in China, quite frankly, that the potential targets are quite limited. It is not easy for you to find the right target, especially for TPG Rise. When we set up our objective from day one is that we have to have both the financial returns that are in par with any other kind of investment that TPG has been conducting in our market, as well as the quantifiable and measurable impact with multiplier effect that we can bring into the society that fall into different kind of SDG kind of discipline. So essentially that is that both end, which has definitely pushed the bar higher than most of the other investment that we're doing in the region. So being able to have an ecosystem that can incubate, promote, and support these kind of enterprise that can grow to the size that allowed it to be financially sustainable and continuously generating impact is another kind of area that we can see that there's a lot of progress has been done in China. But nonetheless, these are the, I think one area is always kind of still needs more attention and more support. The third part is, of course, that it's getting more kind of, it's getting more disciplined and it's getting more crystallized over the thematics and the discipline. But I think that
we can probably sort of pick up that a bit later. We've got quite a few issues all already identified by you guys that we need to unpick. So I mean, there's clarification. I think we've moved beyond the awareness, and I think there's a bit of that discussion on clarification. And maybe now I can turn to Ramnath, because I think Dominic mentioned about all the companies getting more interested. So perhaps you could talk a bit about why companies getting in and why they're so interested.
Oh, actually, I might actually be playing a bit of a spoil sport here, in the sense that we're talking about impact investing, but actually, I mean, it's nice to hear that companies are getting more interested and different countries are building up ecosystems, etc. for this. But if I look at some of the numbers, if I look at what is needed versus what is being done, I think we are nowhere close to anywhere, what really is needed. And if you ask me, I mean, like we look a lot at the area of climate finance, just one area of the whole impact investing spectrum. And even in climate finance, I mean, there are trillions of dollars that are required. We really don't have that yet. And even from what we have, the developing countries actually take a really small, are getting a really small portion of the investments. If I look at just Southeast Asia, the region that I am based in, just 2 weeks ago, there was a report, a fairly comprehensive report on Southeast Asia published by Temasek and Bain and a few others, which showed that in 2022, investment in Southeast Asia in the climate function actually declined by 5 or 6%. So, I mean, I think that there is a lot more that needs to be done, and it is a positive that companies and investors are beginning to take this more seriously. And I think they're taking it more seriously because I think people are realizing that more needs to be done. What's being done is not enough, especially in our region, as a result of which there is I think there is a genuine desire to realize that things are really not working, and therefore we need to step up. I mean, and the second thing is, of course, I mean, we all know that this needs effort from all sides, from government, from private. I mean, blended finance. If I got $1 for every time I heard the word blended finance in the last 1 year, I would be a very rich guy, right? But blended finance really is requiring both the public sector and the profit-driven private sector, and to an extent, a not so profit-driven private sector help coming in all together, because we need all hands on deck here. So that's the second factor that's driving, the focus on impact investing. And then the third thing, of course, is as we move from ESG, now ESG has become fairly popular in some senses over the last 2 or 3 years. But at the same time, in a sense, it has become almost too popular in the sense that everyone's jumped onto the bandwagon. And then there are questions raised about greenwashing. So yes, impact investing becomes a bit more focused. I'll stop there.
Yes, we'll get to that because you've we're getting to the really serious, stuff. So everyone, please feel free to jump in. So Aisha, well, I mean, I don't know. Do you agree with what Ramnath says? About all the investors who are just not keen and there's really not enough money because you've got quite a few small funds.
Yeah, so first of all, wonderful to be part of this robust conversation and, agree with Dominique and Sharon. It's an exciting, dynamic time, but significant gaps, a significant percentage of the populations in Southeast Asia, across Asia that are living at poverty, international poverty levels, and a robust pipeline of growing businesses. But Ramnath, I would absolutely agree. The UN has said it's going to take 4 trillion annually to achieve the Sustainable Development Goals by 2030. And so global philanthropy and aid is 200 billion a year. We must engage the private capital markets. And I'm going to get $1 from you, Ramnath, because one of the ways to do that, talking about trends, is we need to see more blended finance instruments. And certainly CARE's Gender Justice Fund is a blended finance instrument. And what that means is blending capital, blending philanthropy, mission-aligned catalytic capital that de-risks a fund and attracts more commercial capital. We need to see governments and philanthropy, those actors playing a more critical role, being more catalytic, taking more risk. These institutions need to demonstrate to market actors that they're willing to absorb more of the risk so we can bring more capital and have it flow to where it's needed. So I know we'll talk more about that. The other just thread I might pull about specific trends in Asia Pacific is, Dominique, you talked about climate, and there are vast vulnerable populations that live along the coastlines in Asia Pacific. And so investment strategies that consider climate adaptation and mitigation are more important every year. And also with the recognition that there's an intersection between the disproportionate negative impacts that women face when it comes to the effects of climate change. And so what we're excited about seeing is that more and more investors are considering this intentionality by adapting both climate and gender lens. So huge gaps, lots of opportunity, a lot of ways, and it's actually critical for different players to play particular roles to bring the capital forward to blend to address these solutions.
So Aisha, yes, I think we will talk a bit about, the lack of finance, but maybe could you also pick up a bit on what Ramnath said about the, that ESG. So I think, everyone knows about ESG, but, why has that impact investing, come to the forefront, and what's really that difference here? Maybe
yes, so Dominique, you may have mentioned, ESG is a global standard. It's been very helpful to move public companies and large institutions to consider impact, but it's about risk. It's an exclusionary screening tool. It requires a passive investment strategy. So impact investing is about improving people's lives. And so going back to the trust survey and what Jason shared about how do we have more positive impact on society? How do companies show that they are having a positive impact on society? Impact investing is a critical lever for that. So it's having a deliberate theory of change that leads to different outcomes for beneficiaries that would not have happened otherwise. It means active portfolio management of an investment. And because it sometimes requires specialized expertise and management, it can be more expensive. It can sometimes be more expensive, and it can sometimes require a technical assistance capability. And just as an example, the reason CARE is in impact investing is because we have gender experts that are in Cambodia, in Indonesia, and in Vietnam. So we raise separate philanthropy and support through a technical assistance facility those gender experts working side by side with those businesses. That's a technical assistance complement to an impact investing fund. So I think there's a intent to try to have a positive impact and a recognition that ESG has been more passive. And while it's a global standard, it hasn't moved the needle on some of the core social issues. Ramnath, back to the point that you were making, and it certainly is not positioning us to achieve the Sustainable Development Goals by 2030.
Yes, so we've really got these gaps and so on. So I don't know, Dominic, maybe you might want to comment a bit about, these gaps. Why aren't people coming in? But I mean, ADB is doing a lot, so perhaps you could comment there.
Yeah, thanks. Well, I mean, we're definitely also learning too, because in impact investing, although there's a general thought leadership that's emerging around the world, there's no one set standard. And maybe that's not necessarily a bad thing, because one size fits all doesn't work. So let's take, for example, climate. We talked a lot about climate. I think for mitigation, it can be easier to be precise and scientific around measuring mitigation. But as Aisha mentioned, climate adaptation, supporting populations that are vulnerable, is increasingly important. But the impact framework for measuring climate adaptation is much more challenging and complex, because often the impacts are indirect. And then you start getting into making assumptions and how robust are those assumptions. So I think general principles are, you want to be transparent around your assumptions. But the other challenge we face is that if you're doing a very large impact investment, you can justify investing a percentage of TA, technical assistance, into measuring it very robustly. But if you're doing early stage and you're making smaller investments, 500,000, $1 million, how much do you invest in being precise? And sometimes when you try to be too precise, you become imprecise, because the easiest way is not to measure what you can't measure, if you know what I mean. But by ignoring it completely, it's a suboptimal capital allocation. So like I mentioned, I think we're still learning, but one methodology we're trying now is that if you're doing early stage and doing lots of investments, don't just focus on the potential at that point, the potential impact, and have a very strong rationale on what often development practitioners call the theory of change, and get an understanding on the unit impact. If one more product or service of this company selling, what will that impact be? But then revisit maybe 5 years later when this portfolio grows, and the chances are only 2 or 3 of those companies will really grow, expand. And there's a correlation between commercial performance and impact, because if you don't grow commercially, you can't also generate impact at scale. So that's an important point too. But then when those companies do grow, maybe that's the time to do an impact audit on those. And it could be an independent audit by someone else too, because we might be biased too and trying to over declare the impact we have. But it's definitely an emerging space, and it's an interesting space to be had as well. Yeah, to be in. Thanks.
So maybe Ramnath could jump in there. So, okay, so there's the shortage of funds. Is it because it's so difficult to measure the impact? Well, no, whether you've succeeded or not. Maybe you could talk a bit about that, that shortage and this, how to gauge that success. Is that one of the reasons why the impact investing isn't, maybe as the funds haven't flowed in as much as we would expect?
Yeah, no, I'm not sure if that, I think that is a challenge. Measuring impact. How do you measure impact? The various, how do you compare different impacts? For example, if we had a fund that's addressing SDGs for, say, health, and we have another fund, let's say Aisha's fund on gender. Now, these are 2 very different subjects. How do we, if we were to compare the 2, it becomes really challenging to how do you compare the impact across different verticals and also across different geographies. So that, of course, is a challenge. I'm not sure that is the reason for money not flowing in as much. I think the reasons for that, frankly, could be quite manifold. It could be something as macro as the fact that, you know, the global economy has been facing a tough time over the past, you know, year and a half. And, you know, most countries have been grappling with inflation, you know, low growth. People have been seeing their standard of livings coming under question. So I think it doesn't make for a great investment environment from that point of view. That you have interest rates going up, which makes, you know, the cost of money quite expensive. So these are like more sort of macro reasons, but they are important reasons why the flow of money may be quicker or slower. And then partly also on the positive side, as I was alluding to initially, the fact that ESG, and as both Aisha and Dominic very correctly mentioned before me, ESG is more a measurement of, or rather an indicator of risk to the investor, as opposed to the impact that the investor is making. So I think there is beginning to be an understanding of it. I mean, the fact that there are a lot of oil companies which are rated as, you know, A in ESG, while some other companies which unarguably are probably doing more good for the world, but for various other reasons are rated below, kind of tells you that what they're measuring is something quite different from what sometimes people think they're measuring. And therefore, impact investing and outcome-based investing, or let's call it, sort of more direct outcome-based investing, I think that's becoming more, that's beginning to start, people are beginning to understand the difference. So again, if I take a more positive view, I would say that actually people are beginning to understand. There are serious, there are challenges, I wouldn't say issues, but I would say there are challenges to measuring impact. And that is something that is quite natural, because we are used to a world, or we are used to looking at investments from a single lens most of the time, which is what are the returns that we are getting. And now when we are looking at impact investing, we actually need to look at it from a very different lens. The very starting point needs to be, okay, it's not just about the return. What is the objective in the first place? What is the outcome? The return has to match to the outcome. And then, we can go into a lot of discussion here, but again, whether it should be a single outcome focused, what if it is doing some negatives on the other outcome? Should we be looking at net impact versus just single outcome impact? And we can argue about this. There are a lot of methodologies. So which is why it becomes challenging, but I think it's important to know the direction in which you're looking.
Yeah, so maybe at this point, I could say, for people, we've got people in our audience, we've got companies, we've got funds and so on. But perhaps how should one start, therefore? Say, okay, I do want to put some money in. And so how would I start on that impact investing journey? Maybe I could get some comments from the participants, but Ramnath, you could start, because I think Dominic talked a bit about putting a lot in early stage, and others may be doing it in that large space, because therefore you can see the impact. Just some thoughts about getting started.
Okay. If I were to keep it more as a principle, as opposed to getting very specific, I would say that you have, one is investing for impact, but secondly, and this is where if you're starting to look at the space and if you're starting to do things, the second thing also, it's equally important, the investment itself needs to be impactful. By that, I mean, an impactful investment is one which comes in when maybe some other investment was not willing to come in, which goes back to, a couple of points mentioned about willing to take more risk than the average investor, maybe willing to take a lower return, or maybe willing to be an anchor in a risk project, which then drives in, as a result of the anchor being there, which then drives in other investors in a way that de-risks the project. And these are, I would say, not just impact investing for the cost, but these are impactful investments. And therefore, one way, if you really want to make a difference and want to look at impact investing, with a fresh lens, is to then start with looking at those funds They could be in the private markets. They could be in the semi-public, semi-private markets. They could be primary markets, probably more so than secondary market. Those would be really impactful. Of course, there would also be funds that would be outcome oriented, which is perfect.
Okay, Aisha, what are your thoughts on that? You're starting.
I think putting aside a pool of money that you're willing to take more risk with, you're willing to experiment, be a little innovative around, having a portion of someone's time on your team or part of the team that is focused on impact investing, gets educated about that, getting clear about the values and what you're trying to accomplish. I think with corporations, sometimes it's internally connecting silos. So you have a foundation and CSR money over here, and you have investments that are happening over here. So internally connecting and saying, what are some shared objectives that we can accomplish? For foundations, I mean, there are 700 family foundations just in Singapore. And so family foundations can play a critical role. So it's changing the mindset. It's also beginning to change the mindset and say, instead of getting negative 100% return from grants, how do I drive impact and just preserve the capital or get a market adjusted return? And how do I carve out part of my portfolio of grants to play this kind of role? So I think there are ways to dip your toes in, but I think you hear all of us saying there's an urgent need. There are companies that are coming out of the pandemic. They have product market fit. They're ready to scale, but they can't tap into traditional financing, this missing middle. And Dominique talked even further upstream about venture, and we need to build these resilient businesses. They need capital now, and there's urgency with this. So start doing it. Start doing it and experimenting.
Okay, Dominic, maybe you could comment on that, but maybe, just can you also take on the point about, well, as all this is happening, I mean, do people think, can you really get that impact? Can you get that return? Is this just a bit more about companies, even before we've done with greenwashing, we've now got this impact washing. So, Dominic, maybe you could take that point. Okay, where should we start? But, we may have a bit of a credibility issue at the same time. So, yeah. So your thoughts on that?
So I think, I mean, building on what Ramath and Aisha just said, when you get started, of course, I think it's important also to pick a particular subject that you're really passionate about, something that you're really committed to, that excites you. I think that helps when you're getting started on something. And then, it's about, how much risk you want to take and what's the return profile you want. And I think to answer your specific question, there's a lot of options out there, really depending on where you are in that continuum of return that you want on your capital. So even just as a couple of examples of things that I'm currently working on, right? So one is very specific to climate adaptation in very, very small, challenging markets, like the landlocked countries or small island states like Pacific Islands or like Laos, Cambodia. And clearly in these markets, the markets are so small. If you really want to have impact localized in these markets, you probably will compromise a little bit your financial return expectations, but the impact at a local level can be huge. And when you enter into that sort of an ecosystem, it's actually quite easy to find partners because it's very fragmented, but everyone in the ecosystem wants to work together because it's such a localized market. And it's actually quite a nice experience actually of going in and you can really make a big difference in these small markets. But then at the other end of the spectrum, when you're talking about investing in, not necessarily very, very early stage startups, but companies that are sort of growth stage. I mean, it's conceivable there that if you invest well, you have a good portfolio, you can be getting reasonable, decent returns. At least you should be targeting decent return targets. And I mean, even in the China ecosystem, maybe, Sharon can talk about it later, but we're seeing also that there's just great Chinese technology now that's potentially could solve problems in Southeast Asia. So, a lot of our focus is also on partnering with Chinese impact investors on China out, because we have operational footprint in Southeast Asia, and not all the problems in Southeast Asia will be solved by local homegrown solutions. There's definitely room for inbound from around the world. And yeah, the investors in that space that we're co-investing with, often they're quite commercial. So they're looking for returns 20 to 30%. So, you know, there's impact along the whole spectrum, and there's returns to be made at different stages, but it really depends on where you want to put your capital and where you want to make the difference. And you can make a difference in many different ways. So there's options. Thanks.
Okay, so maybe I could move to Sharon. I mean, so perhaps you could talk about, you know, a bit about this impact washing and you know, maybe some your final thoughts on you know, how we could get perhaps more money into this space, and then you know we'll do a bit of a wrap up so that we've got time for some Q&A, because I think we're going to get some real you know, challenging questions from the floor, I hope. So Sharon, perhaps you just give us your final thoughts.
Yeah, so I think the panelists that has touched on a few very, very important kind of criteria. One is that I think impact washing at the end of the day is actually a matter of trust and credibility, right? Then how do you ensure that trust is in place? One is that the measurement topic, I think everybody has touched on. There are different kind of solutions that that the players at different stage and different skill can adopt. For ourselves, that from day one, that we set up a fund with the commitment that every single impact investment we're doing has to have like measurable, verifiable, and third-party kind of independent auditable impact. That's purely, even just like for the purely quantifiable part is a hurdle that it has to be audited every year. And we have One Analytics as the public benefiting institution that has done a lot of empirical research, because at the initial kind of learning phase that we realized there's a lot of external kind of intangible impacts that we're not able to put into a proper measurement. And I believe that's the part a lot of the players in the sector are facing the similar challenges. So that's why analytics was founded, in order to kind of conduct research to build a foundation that for this entire sector. So please feel free to leverage on the work, that there are a lot of kind of empirical research has been done that can be leveraged to provide a foundation of a lot of the great works that the impact investment portfolio companies and social enterprise are doing, that can actually be translated into something that that can be more acceptable by the more institutional kind of financial investors. So that's one part, that's the foundation part. But coming back on the impact investment, impact washing itself, I think important thing is that to looking backwards, to look at your source of capital and pocket of capital. What are the criteria and the foundation's decision-making matrix that they're adopting when we're talking about there's not enough financing, there's not enough capital in the market. The reason why we took the approach that we have to have both the market return and as well as the impact multiplying effect is that if we want to attract the large scale institutional investor like the pension fund, the sovereign fund, the large corporate, number one, like important thing we need to address their fiduciary duties to their kind of partners, to the retirees behind them, to the population that's funding those kind of large public foundation. If you cannot address that, then everybody wants to do good, but at the end of the day, that we have to be kind of taking the responsibility to fulfill the primary objective is that preserve the wealth of whoever is behind the source of funding and fulfill our fiduciary duty at the first place. Before that, we can talk about how we can generate more impact to the society. But I'm not saying that this is the only way, is that this is the way that we are adopting, because we want to focus on supporting the company that has already got a skill. And we want to focus on that, bring the larger scaled source of capital into the space. If we're doing early stage, then of course there are different kind of criteria, but the important thing is that to crystallize the criteria of your decision making, and also crystallize that exactly what the, I think on the front end, that on the investment side, that what are you going to be able to deliver that are fitting into the mandate and the objective of your funding partners behind the space. That is the most important thing to me, that that if we want to address like that we don't have enough capital, that you have to really kind of understand that what the capital has been thinking and how do you kind of meet their needs in order to create a matching in between.
Okay, Sharon, thanks a lot. Very, very interesting. We've got that large, big picture, you know, for the large funds and the large amounts. Maybe Dominic, could you chip in here? Some final thoughts.
Yeah, sorry, final thoughts on the point that Sharon just made, or just generally, sorry, in terms of?
Generally, yeah. About the funds that are coming in, you know, where should we start? Just some final thoughts before we get to Q&A.
Yeah, so I mean, I think we've covered a lot of ground already in the session, but I would just say that going forward, personally, I would like to see the way that we measure impact become, like I say, I don't think there'll be one process, one methodology that will be adopted by everyone. But when I meet with a lot of these financial institutions and pension funds in Japan and Korea, they're all very interested in working with us. But all their questions they ask are not to do with the commercial returns. They're asking always about the methodology. So it seems like they really want to do it, but they're very curious about how does ADB do it, or what's the way. So I think I hope over the next sort of 5-10 years, like we can be working with some of these large financial institutions towards a common understanding on the fundamental principles. And, you know, I mentioned some of those principles around, you know, being transparent and accountable to whoever's investing in the money, that, you know, you know, what assumptions you're making, publishing those assumptions around, you know, when you make the investments, all your assumptions are transparent. Everyone knows what assumptions you made. You revisit those assumptions post investment when you evaluate the portfolio. And maybe for those companies that really do well and that you attribute most of your impact to, you know, expose yourself to an audit by a third party. So I hope, you know, over time, the robustness and methodology and principles can evolve. Because I think if we can do that and we can unlock some of this capital with the large financial institutions in the region, we would go at least some way towards filling this gap that we're seing now. Yeah. Thanks.
So Rana, maybe I could turn to you, and you know, where do you think will be, you know, that demand? You know, one of the biggest demands in terms of impact investing. Where do you think that would come from? Perhaps you know, as you wrap up with your final thoughts, do you think, you know, will it still be the companies, or do you think it'll be some of the family offices, perhaps?
Let me just unmute myself. Sorry. I actually think that there is a recognition and a willingness or a desire on the part of many individuals, rich families, you know, people with capital, that we are facing some significant challenges in the world which can't be pushed back too much longer, and they want to do things beyond just financial return. And I think there is. So that's on the positive. I started by painting a slightly more, you know, negative picture, but I think if I were to look at the positive side, and like it was mentioned, we see a number of family offices setting up, not just in Singapore but elsewhere. And I have personally met some who have a very clear dual mandate, one which focuses on returns, but one which also has an impact or a social kind of mandate, which is not entirely focused on a single criteria. So I think there is increasing recognition of that. I think governments can also do more in this field by, you know, maybe changing some of the structures in terms of how they are taxed, etc. And that obviously depends on each country and, you know, each jurisdiction. But I do think that private philanthropic slash semi-profit driven, but with an objective. I think that would also play a role.
Okay, so Aisha, maybe you could just talk a bit more and your final thoughts and maybe about the criteria for measuring success.
I think while we're a learning, dynamic community of investors, we also have some standards in place, and we have models that have worked, and we actually have track records. So I think there's accepted global standards around climate. There are accepted global standards around gender impact. 15 countries have signed on to the 2X Gender Challenge. It's a standard global framework. So what I would I guess emphasize is that we're going to continue to evolve and learn, but there are models that are working and measurable impact that is being achieved. And so we just need to take on these global issues collectively and do so with boldness and with a different understanding of the purpose of money and what it's for, and how we can really galvanize capital markets to make the changes that we need to see as inequity grows, as poverty grows around the world. So I guess I would just leave there. I think we've touched on a lot of different dimensions. Certainly, I guess on the impact side, similar, Sharon, to the Rise Fund and other funds, we hold ourselves to both financial returns and impact returns. We have a disciplined methodology that's been put in place, and our compensation in the fund is based on both achieving those financial metrics as well as the impact metrics. So I think incentives are changing, and we're holding ourselves accountable as a fund, as other funds are as well. So I think it's an exciting time to be part of this movement around the world.
Okay, thanks, Aisha. So we've got a couple of questions, and I'll just quickly get to them as we're running out of time. One of the questions is, what do you think, where are the 3 most important areas which require investment? Would it be APAC? Would it be Southeast Asia? I'm not sure who wants to take it. Maybe Dominic, you could just quickly take that from your perspective.
It's quite a broad question, but I mean, in the end, I don't want to say that there's one particular issue that's most important, because everyone will have their own passion about solving a particular problem. But if you talk about geographically, because for ADB ourselves, when we get involved in a space, we also have to assess what's our additionality and what's the gap. Because ideally, if there's already commercial capital or sufficient commercial capital in the region, we don't need to go in ourselves. So for example, in the early stage climate space, when we were analyzing the flows into Asia, I think going back to the point that Ramnath made, first of all, as a region, we actually are a relatively small percentage of the total global flows on climate finance when you consider the magnitude of the problems in the region. And when you further dig down deeper into the region, a lot of that funding is actually in China and later stage, because China's ecosystem is fairly developed. So so we made a conscious decision that, okay, we would focus in Southeast Asia, we would focus on South Asia, and also we would do slightly earlier stage, and we would partner, for example, with China ecosystem on China out rather than focusing on China in. So it's not to say that, there's not something important to be done in China. I'm sure there are many ways to engage in China, but we established where we felt we could make the biggest difference with our essentially very limited funding, because even ADB as the largest DFI in the region, it's minuscule in terms of the funding that's needed in the space. So I think whatever your passion is or whatever you believe in solving, the first thing is to just look at where is the money already going, who's already investing there, assess the gaps, and then there's always going to be like-minded partners, other investors, ecosystem builders operating in that space, and then you build on that, work with them. And then, when like-minded, passionate people come together, I think good things can happen.
Okay, great. Thank you very much. Now we've actually really run out of time. We've had a discussion. We've talked about funds coming in, criteria, impact washing, and so on. We've actually got quite a lot more to discuss, but we've actually run out of time. So it just remains for me to thank everyone for their time today. Thank you, audience, for your questions. Thank you, Dominic, Sharon, Ramnath, Aisha, and thank you, Edelman Smithfield, for organizing this panel on this important topic. So thank you, everyone, and have a good day.
Thank you.
Thank you.
Thanks, Sushan.
Thank you.
Thank you, Jason.